In the sweltering heights of the Andean capital, where the air hangs thick with the aroma of tinto and arepas, a subtle but seismic shift is underway. It's a shift that portends far-reaching implications, not just for the economic fortunes of this proud Spanish-American nation, but for the ideological fault lines that have fractured the global financial order. The news hit the wires like a thunderclap. Colombian inflation, that insidious force that has haunted the dreams of policymakers and eroded the buying power of millions, has slowed to a mercifully lower pace than anticipated. At 6.86%, the July reading marked the lowest annual inflation rate since those halcyon days of 2021, when the world seemed a less precarious place. To the carefully trained eyes of the economists, analysts, and prognosticators, the 0.2% monthly uptick in consumer prices represented not a yawning chasm, but a mere ripple on the surface of an economic tide that finally appears to be turning. After an unsettling detour in June, when inflationary pressures stubbornly refused to abate, the data signaled a resumption of the long-awaited descent, a harbinger of relief for a population that has witnessed its purchasing power wither on the vine. But as is so often the case, the cold, unvarnished numbers only begin to hint at the larger narrative unfolding across this kaleidoscopic nation of 50 million souls. For the implications of this latest inflation reading extend far beyond the realms of economic statisticians and armchair analysts poring over reams of data. No, they cut to the very heart of an intensifying philosophical tug-of-war between entrenched financial orthodoxy and the increasingly clamorous voices advocating for a wholesale reappraisal of the prevailing monetary doctrine. On one side of the deepening divide stands the Colombian central bank, Banco de la República, that vaunted custodian of macroeconomic stability, which has steadfastly wielded the blunt instrument of interest rate hikes to combat escalating prices. In the opposing trench rallies President Gustavo Petro, the former guerrilla fighter who has swapped the fatigues of the M19 for the snowy grandfatherly mien of a head of state, and his cohort of self-avowed economic progressives. To President Petro and his acolytes, the central bank's reflexive predilection for monetary tightening, most recently evidenced by July's half-point rate increase to 10.75%, represents an outmoded relic, an antiquated salve ill-suited to treating the unique pathologies afflicting the Colombian economy in the wake of the COVID-19 pandemic and the ructions stemming from Russia's unconscionable invasion of Ukraine. No, they contend, what Colombia's economy desperately needs is a panacea more potent than mere interest rate increments. A remedy that can resuscitate the sickly veins of growth and catalyze a desperately needed renaissance of investment, employment, and robust consumer demand. On the day preceding the inflation release, Petro launched his latest salvo, reiterating his fervent calls for the central bank to accelerate its tentative monetary easing and uncork the fetters constraining the nation's economic potential. The ideological schism coursing through the heart of Colombian economic policymaking is emblematic of a broader global disquiet. From the atavistic quarters of Trumpian America First populism to the insurrectionist rumblings along the fringes of the European political mainstream, there has emerged a widespread skepticism, and in some quarters outright repudiation, of the long-prevailing neoliberal economic consensus. Unfettered free trade, deregulation, fiscal austerity, these totemic paeans to the doctrine of self-correcting markets, have increasingly been called into question amid a creeping resurgence of economic nationalism and demands for short-term respite over long-term incremental reform. The phenomenon has clear historical echoes. In the smoldering malaise that followed the 1929 stock market crash and the dark valley of the Great Depression, large swaths of the industrialized world embraced the economic interventionism of Keynesian doctrine. When the post-war boom gave way to ruinous bouts of stagflation in the 1970s, the ideological pendulum swung back towards the supply-side bromides and deregulatory zeal that would ultimately coalesce into the Washington Consensus. Now, with the lingering aftershocks of the global financial crisis compounded by the dizzying array of macroeconomic shocks in recent years, it seems the policy mainstream is being bombarded by yet another volley of heterodox dissent. Whether the protagonists represent a fleeting spasm of imprudent apostasy, or the vanguard of a new era of reform whose ultimate contours remain maddeningly indistinct, remains to be seen. If July's inflation datum in Colombia is any indication, President Petro may find increasingly fertile ground for his unconventional arguments. For while 6.86% annual price growth remains well above the 3% target rate, the clear inflection displayed by the data has emboldened the economic progressives seeking a pivot towards more aggressive easing. Analysts at the venerable Scottish bank Scotiabank Patria have already sounded the clarion call, prophesying that Banco de la República will indisputably accelerate the pace of interest rate cuts when it next convenes on September 30th. Likewise, the estimable U.S. banking titan J.P. Morgan has theorized that steadily receding inflationary impulses will compel Colombian monetary authorities to embrace a more accommodative policy stance in the meetings ahead. For the economic mandarins within the hallowed confines of the central banks imposing modernist high-rise in downtown Bogotá, the path forward is unlikely to be an easy one. On one hand, they must internalize the latest inflation readings, which irrefutably demonstrate that their preferred arsenal of inflation-fighting rate hikes has gained meaningful traction over the past year. After lifting the benchmark rate a staggering 10.25 percentage points since the tightening cycle commenced in September 2021, it is evident that the central bank's aggressive actions have choked off the unfettered demand that previously stoked escalating prices. As disposable incomes are sapped by ever-costlier debt service payments, the inexorable laws of supply and demand have reasserted themselves, euthanizing the once virulent inflationary spiral. But by the same token, evidence is rapidly accumulating that the economic pain inflicted by this draconian rate regimen may be nearing its outer limits of political and social viability, as Petro's coalition becomes more vociferous in its castigations of belt-tightening. Tito Hernandez, a veteran central bank watcher who presides over the economic consultancy Gemines, diagnosed the conundrum facing policymakers with unvarnished candor. We are facing a scenario where inflation remains relatively high and core readings are sticky, but growth will slow further and labor conditions will worsen if we maintain the current monetary policy stance for too long. Hernandez's sobering prognosis spotlights one of the eternal verities of the dismal science. In the inherent tension between restraining inflation and sustaining economic vitality, monetary policymakers are condemned to a perpetual tightrope walk where the consequences of even a seemingly minor misstep can be calamitous. Indeed, even as the latest inflation report ostensibly buoyed President Petro's clarion calls for accelerated monetary accommodation, his nemesis were quick to dismiss the data as an outlier, an ephemeral blip totally unworthy of dictating a dramatic pivot in policy. 1 month of relatively benign inflation doesn't make a trend, cautioned Miguel Cuellar, a prominent economist at the University of Los Andes in Bogotá. The risks of an entrenched inflation process are still very real. The central bank must resist the siren calls for premature easing if it wants to secure a durable disinflation process. Cuellar's more hawkish viewpoint underscores the unenviable predicament confronting Banco de la República as it weighs its next fateful policy decision. Move too gradually in loosening monetary conditions, and it runs the risk of unnecessarily prolonging the debilitating economic contraction that has already borne brutal consequences for the working class and marginalized communities.